Welcome to this introduction to algorithmic trading, where we unpack the core ideas, goals, and practical steps behind automated market strategies. Over the next slides, we'll move from the ecosystem of participants to workflows, models, and implementation choices so you can see how research, execution, and risk controls fit together in a cohesive trading program. This diagram highlights the ecosystem around algorithmic trading, showing buy-side asset managers, sell-side banks, high-frequency market makers, and retail quants all interacting through the market. The central theme is how algo deployment functions execution, market making, and alpha generation connect participants, with each player contributing different services like liquidity provision, portfolio management, or automated strategies. Think of the end-to-end workflow as a pipeline. Ingest high-quality data, mine signals, run robust backtests, validate results, then deploy live with controls. The key prerequisite is an economic rationale before chasing statistical fit. So we focus on causal relationships, avoid spurious correlations, and build interpretable models that mitigate overfitting and non-stationarity during real-world deployment. There are two broad strategy logics: trend following, which capitalizes on persistent moves like post-earnings drifts, and contrarian approaches, which bet on mean reversion after overreaction, for example, an RSI bounce from oversold levels. Both depend on market regime and share core parameters such as look-back window, entry threshold, and how much capital to allocate per signal. Predictive modeling combines methods like regression, classification, and ensemble techniques with thoughtful feature engineering drawn from order book data, sentiment analysis, and even satellite indicators. The goal is an enriched feature set that improves volatility and return prediction. But remember the key principle: garbage in, garbage out. Model quality is tightly coupled to data integrity and signal relevance. Robust model selection relies on finance-aware validation. Use rolling window splits to detect live drift, apply embargo periods and financial cross-validation to avoid leakage, and evaluate with performance metrics like Sharpe ratio, compounded growth, and max drawdown. This methodology helps ensure the model generalizes to new market conditions, rather than just fitting historical quirks. Pre-trade risk management combines hard limits, automated error prevention, and regulatory compliance. Set position and sector exposure limits, beta thresholds, and kill switch logic. Run automated checks to prevent fat finger errors, and meet obligations such as MiFID II or SEC market access rules, while keeping real-time risk monitoring in place to detect anomalies before trades execute. Execution tactics center on benchmarking and TCA. Use VWAP, TWAP, point of view, or arrival. Price tactics depending on objectives, and measure slippage, market impact, and timing risk to quantify cost. Transaction cost analysis feeds back into execution strategy to preserve alpha, lower transaction costs, and create a continuous optimization loop between trading performance and strategy adjustments. Technology choices balance latency, flexibility, and cost. Python offers rapid prototyping and flexibility. C++ delivers ultra-low latency for execution, and Java sits between performance and ecosystem robustness. Combine open-source backtesting tools or commercial platforms with infrastructure choices like co-location, cloud scaling, and careful TCO planning to align performance, reliability, and budget. Successful teams blend complementary roles. Quant researchers build and test models. Developers implement algorithms and maintain infrastructure. Traders monitor execution and risk, and compliance officers ensure regulatory and audit readiness. Underpinning this are processes like code review, version control, audit trails, and documentation to preserve quality, reproducibility, and knowledge transfer across the organization. A practical getting started checklist begins with foundation and data. Open a paper trading account and download minute-level data, then code a simple mean reversion strategy and run walk-forward tests. Log trades during simulated execution, iterate through learning cycles, and scale gradually with incremental capital deployment while continuously refining the approach based on observed results. For continuous learning, leverage curated resources such as MOOCs, GitHub examples, and community forums. Set measurable goals like achieving a Sharpe ratio above 1 in simulation before risking real capital, and maintain a micro-learning loop. Analyze results, refine strategy, apply new knowledge, and engage in Q&A to keep improving while emphasizing risk management at every step.